video and all other videos on this channel are for entertainment purposes only. The content of this video and all other videos on this channel are the opinions of the creator only and do not constitute legal, trading, investment, or financial advice of any kind. Investing carries a high level of risk and the majority of retail clients lose money. Do not invest any capital unless you understand the risks and you are prepared to lose it all. Right, hello and welcome to Camel Finance. I'm your boy Camel, and this is the weekend's deep dive. Today, before we get into this, I want to kindly ask you to subscribe and turn the notifications on, because on Monday, we are going to begin the process of setting up these trades out of the cycle lows for the stock market, for Bitcoin, and for the precious metal markets. If you're new here, if you're unfamiliar with the channel, we do things a little bit differently around here. We call the trades out ahead of time, as I have been doing for weeks now. We are now, as I said, on Monday, going to begin the process of setting up these trades. We are going to publicly get behind these trades. And here's the key part. We're going to set public stop loss and invalidation levels so that if I am wrong, I cannot possibly hide from the fact. I will have to be publicly wrong in front of everyone. And the reason I do this is to try to uphold a higher standard of YouTube traders on this platform. I believe far too many people post an arrow going up and an arrow going down. They wait until after the fact, and then they tell you that they nailed the trade. But I don't believe many people give you actionable signals. I don't believe many people can actually do what I do. So if that sounds like something you're interested in, please do hit that subscribe button, turn the notifications on, watch me start to set these trades up as we approach the cycle lows, and then we will see what the market can give. Now today, this is the weekend's deep dive. On the weekend, we like to come back and re-examine the base case of the channel. I've held this base case for around 2 years. I think it's been over 2 years now. And whilst it has taken longer to play out than I expected, it is still on track. So I've got some new data to show you. As ever, we're going to run through this thing from the top. And then, as I said, on Monday, we're going to start to set these trades up and start to clearly define the buy side signals. And of course, if you're a level 3 member, I will notify you in real time of the exact levels when I pull the trigger. So starting from the top, at the lows, I was saying, I think we're too bearish, we're going to break out, have a blow off top to all-time highs, and then come tumbling down in a global bear market and recession. And here's the key part, this recession would have, for the third time in America's history, a deflationary component to it. We've also been making the case that once this high is in, it may well remain the high for up to a decade or more as we experience another one of these lost decades where the stock market consolidates for somewhere between 10 and 16 years as the oscillator down the bottom resets itself. Of course, there will be trading opportunities short term. And in fact, the rallies off the lows can be very, very violent and very, very profitable. But unless something changes, unless this can curl up and uncross, then I do maintain once we see the top come in eventually, we will be able to experience one of these lost decades, possibly even with a stagflationary component. Fast forward to today, and it seems that more or less we have played out in a blow-off top. It seems we have had 3 angles, and we have fired the first early warning signal, which is a third angle violation. Nothing significant has changed here pertaining to the stock market. We are still hanging around in no man's land. For me, a sell signal is a second angle violation and breakdown. If we are to get this, I have to call that the top, and I have to start to say that this blow off top has completed and we start to target much, much, much lower down. However, if what we can do is continue to chop and range here into perhaps early March, hit a cycle low and then bounce, then we will be able to once more repeat the process, get long out of there and look for another third and final angle to come in. And then we just repeat the whole process again. We sell on a third angle violation and we call tops once the second angle is truly broken down. So far, it could really go either way. As you can see, we're in no man's land. We have had 3 angles. It wouldn't at all surprise me if we did get a breakdown. Although until such time as that happens, I can't possibly call tops. And indeed, if we can bounce off of support and continue to rally here, then of course I want to be long and want to be on board for that. For now though, I've been taking my time and so far so good, okay? Continuing to range, happy days. For Bitcoin, this remains the one component for me that didn't quite play ball. I successfully did predict the all-time high pre-halving, but of course we spent way longer in here consolidating than I was anticipating. So of course as new data presents, I'm forced to pivot and adjust to that new data. And instead of calling for this, which was the original call, we of course had to wait for a true buy-side signal, which was a trendline breakout, which did not occur until much later in life. We are now, though, in the middle of potentially seeing a Q1 top formation. Now, it's not yet a call, and this schematic, as far as I'm concerned, has not yet played out since we need to see it overthrow the top of this channel. And this remains a point of contention in the markets. There is a lot of speculation that this may well be the top, and what comes next is some kind of rollover and a breakdown. And of course, there is a lot of other market participants that are calling for this bull market to continue up a little while longer. So as ever, we're going to keep taking this thing one day at a time. If it starts to immediately squeeze higher like this, then I would say with a pretty high degree of confidence, this is what is in play. However, at the moment, it looks an awful lot to me like we may well be having to entertain one of these weekly cycle lows and doubles. Okay, you can see the weekly cycle lows form approximately every 6 months. You can see for Bitcoin, these are very consistently equidistant in terms of time, as denoted by the blue arcs down the bottom. You will also note that we are just a couple of weeks away from hitting a perfect weekly cycle low timing window, and when we do, it is reasonable to expect a doubling in the Bitcoin's price. The reason I say that is because every other weekly cycle low led to a double. You can see 94, 98, 90%, 120%. So I think conservatively, if we can put in a low somewhere around 89k, we should be targeting around 180k. The nice thing about this is, as we set up these trades out of this cycle low on Monday, as I was saying at the beginning, not only will I be expecting and hoping to see a double come out of here, but we will also be drawing a line underneath this cycle low wherever it forms and using that as bull market invalidation. Any kind of bounce up from here, should it occur, followed by a left translation and a failed cycle, will be me selling spot. I also ran this idea past Bob Lucas, and I asked him if he agreed with lightening up spot if this upcoming weekly cycle low were to fail, and he said he would argue it's a sell the whole lot event. And that's kind of what I've been thinking too. I've been saying this consistently for a while now, that we need to draw a line underneath this weekly cycle low, and any kind of trade below that would indicate that indeed the Q1 top call was correct. That really was the top. And thus, for me, I will have to be locking in the gains from the spot position that was acquired down at the 4-year cycle lows. So for now, that's Bitcoin. As I said, we were a little bit ambitious, a little bit overzealous early on, but it did keep us on board for the ride up to the all-time high pre-halving. Then what we did was wait for that breakout and readjust as new data presented itself. We were able to catch that move to the upside as well. And now here we are, getting ready to repeat the process. As I said, we managed to catch this weekly cycle low and catch hold of that. And we are now just weeks away, perhaps even less, from catching another weekly cycle low and expecting another double. So please do tune in on Monday as we start to set these trades up. The next component of this idea is that if we really are going to get a breakdown, if we really are going to get a global bear market and a recession, we should expect to have a deflationary component. We have long been suggesting anything you do to the M2 rate of change shows up in the US inflation rate with a lag. And shout out to E here, who has made an updated version of this chart. And you can see this thing is still very much on track to see CPI and inflation continue to move to the downside. Now, I know this is a very, very contentious point in the markets at the moment between participants, because what many people believe we're experiencing here is a 1970s inflation fractal repeat. I know a lot of people think that inflation is going to continue to be sticky and continue to rise just like we saw back in the 70s. And this is largely speaking because of late we had seen inflation bounce from around 1% up to around 3% according to the Trueflation metrics. But I continue to make the case that all this bounce was a counter-trend wobble within the primary trend, which is down. I continue to make the case that this whole idea is nothing similar to the 1970s situation. I continue to make the case that people thinking this is normal and to be expected are on the wrong side of this, and that this primary trend will continue to the downside. I continue to make the case that deflation and disinflation are the risk here rather than resumption of inflation. All through this counter trend wobble, people were quite upset with me for suggesting that, but I suggest to you that this is now well on its way to continuing the disinflationary path before ultimately we slip into a short period of asset price deflation. The next component of this is if we are going to get a global bear market and recession, we would of course expect to see labour market deterioration. And yet, what we saw this week was the unemployment rate come in at 4%, below both the prior readout and the forecast. This was also enough to see the SAM recession rule print another new low, now coming in at 0.37, which is quite significantly below the 0.5 threshold required to flash a recessionary indicator. With that said, I would still like to see a new lower low below this low to consider this trend broken. At the moment, at the hard right edge, all we have is higher highs and higher lows, and until that changes, then there's no telling whether or not this is about to continue to the downside, or whether this is indeed a leading phase before the acceleration, a lead-in phase before acceleration, as we see in all these other cases. So if we want to avoid a recession here, I suggest to you we do need to see a new lower low relative to this low where my cursor is. But so far, going in the right direction for the people that want to avoid a recession. With that said, Michigan's unemployment rate continues to skyrocket. The continued claims spiking. This is leading a lot of people to be frustrated and suggest that a lot of the data is indeed fake or manipulated to some degree. We've got an update on temporary help service jobs as well, which by the way continue to fall at a recessionary pace. So whilst the unemployment rate seems to be settling down, the other metrics we can use are by no means supporting what we're seeing in the officially reported unemployment data. And keep in mind that the downward revisions to jobs are massive. In August, a preliminary revision showed that the jobs have been overestimated by 818,000 for 12 months ending March 2024. The jobs report this week also was revised. First of all, we can see the second biggest negative payroll revision on record occurring for 2024. And we saw that the market's jobs in Q2 24 was also revised by almost 500,000 to the downside. And the Fed analysis also revealed that non-farm payrolls fell 0.1% in Q2 instead of growing 1.1% as reported. So all of this jobs data seems to be totally Mickey Mouse. And whilst there may be some excitement around the US for the report of January sitting at 4.0%, the jobs in 2024 were revised down by around 600k. Average weekly hours worked by Americans fell to 34.1, the lowest since the GFC, when excluding the 2020 crisis low when, of course, people were locked down. This US job market is a mess. Pause your screen and take a good look at this if you are interested. And remember, we keep hearing people talking about 4 or 4.1% being historically low. But 5 of the last 12 recessions on record started with the same or lower unemployment rate. And the 1953 to 54 recession started with an unemployment rate of just 2.6%. So this whole notion, this whole narrative of 4 or 4.1 being historically low is actually BS as well. And yet here we sit with an overly restrictive policy from the Fed. We saw a pause at the last meeting. We are currently 92% in favour of remaining paused in March's meeting as well. And given that inflation is dropping like a stone, given that disinflation has resumed now, despite the majority of market participants looking for a resumption of sticky inflation or increased inflation, whilst your average market participant is celebrating 4%, not understanding that under the hood the downward revisions are getting worse and worse by the week, and this whole idea of 4% being historically low is total nonsense. All of this is occurring against overly restrictive policy. The Fed really needs to cut here. Otherwise, disinflation and deflation risks are going to become very, very apparent in the not too distant future, and we are likely to see unemployment continue to deteriorate. I want to ask you the question, why do you think it is that the Fed is so hell-bent on misreporting the unemployment data? I believe it is because they don't want to have alarm bells ringing out there. They don't want to spook investors till such time as they're ready. Something else we continue to track on this channel is the high yield spreads. We are squeezing in what looks to me to be a historical compression. Of course, historic compression precedes historic expansion, and historic expansion is synonymous with financial crisis. So as it stands right now, no sign of a breakout, but start to get a breakout, and I make the case alarm bells should be ringing. Now, speaking of alarm bells ringing, January's Chicago PMI ticked up a little bit, which again has a lot of investors jumping up and down and saying happy days. However, when we look closely at this, remember a read below 50 is indicative of economic contraction and a read above 50 is indicative of economic expansion. We have been in a recessionary look for a very, very long time. That continues not to change despite this little bounce to the upside. We've also got homebuilder spec inventory reaching insane levels not seen since the 2008 GFC. And we've got the delinquency rate on commercial mortgage-backed securities jump into a record of 11%, again, showing all the familiar symptoms of recessionary territory. So whilst these things take a long time to manifest, and whilst technically speaking we've got no true sell signals yet, under the hood, the deterioration continues to play out in real time. Meanwhile, Americans feel like the economy is in a recession, and their expectations about unemployment over the next 12 months are the most pessimistic since the 2020 crisis. Again, another recessionary look that will make this whole thing very obvious in hindsight once it eventually shows up. And on this channel, we continue to use the yield curves to let us know when we should start to be considering technical breakdowns in the stock market as truly alarming. It is not the inversion we need to worry about. It is not the reversion, but it is the acceleration to the upside that is synonymous with tops coming in. It's the acceleration to the upside synonymous with tops coming in. And based on the 10-2 yield, we can at least say for now, no alarm bells ringing just yet. We had the initial lead-in phase of acceleration, and we were talking about on this channel, what we should hope for here is any kind of reversal or sideways range. If we were to get that, we can start to say, okay, maybe there is a chance that the stock market can bounce off of this second angle and continue to the upside. And of course, conversely, we were saying if we start to see true acceleration here as defined by weekly higher high and higher low closes in the yield curves, then we would largely expect any breakdowns to be occurring here to be for real and absolutely require being respected. When we change this to an even sharper yield curve, which is the 10-year 3-month yield, you can see so far so good. Alarm bells not ringing yet, but this 3-week candle here was enough to trigger the top during the C19 era. So just because we've got a little bit of a pullback here does not mean we can totally relax. Risk happens fast, and it could just be 3 weeks away and we could be up here again. And then of course, if that's to be occurring on second angle violations, it will be a very, very strong indicator that the market has truly topped and is working on a true trend reversal. As it stands though, the pullback that we're getting at the moment though, we are more than happy and welcoming to see. Long may this sideways chop or reversal continue, because if it does, we do not have to be entertaining major tops coming in. However, we do need to keep an eye on this, and we will continue to track this on a weekly basis, because if what we see here is something akin to this, then of course alarm bells should be ringing and breakouts should be respected. For now though, happy days, not too concerning from a yield curve perspective. Speaks to some cycle lows coming up that should produce tradable lows and hopefully new higher highs. So in the stock market, so far so good. I think we need to continue this range a little while longer, find some cycle lows, and then again we will be looking to set these trades up as we go into the next week and start to prepare ourselves ready to catch any upside should it be occurring. And again, until such time as we lose that second angle, no requirement for me to go calling tops. Gold has been an incredible market to trade of late. This move has been incredibly strong. We're about halfway through this daily cycle, so we should be due a daily cycle low pullback into that early March timeframe. We've been capturing this in the level 3 members section since the weekly cycle low in the likes of individual mining stocks, gold mining ETFs, and we've also been playing this via spot silver and some silver mining positions since the beginning of the year back in January. So happy days there. That continues to work out well for the Camel Crew and the members. And for Bitcoin, this thing is continuing to move in a range, continuing to work its way down as the cycle starts to bottom. That's why I was talking about setting this trade up early next week. So do tune in on Monday so that you can see exactly the criteria I'm going to set for my buy signals and how I'm going to handle this thing in real time. For now though, we're getting ever closer to seeing a daily and a weekly cycle low formation. So a little bit more patience will go a long way. No real changes to the plan. So in summary, I think wholly speaking, things are still going according to plan. We do have to watch for that second angle violation in the stock market. Bitcoin is due to bottom soon, as I was saying, with the cycles, and then it will be time to get one final set of trades on for me out of that cycle low, and also use that cycle low as bull market invalidation and the area for me to lighten up spot or even dump the whole stack should we fail that cycle. Precious metals continues to be a nice market to trade. We continue to capture that, as I said. The inflation story, I continue to make the case that most people are wrong about that, and disinflation has resumed here. I continue to make the case that the real risk here is deflation rather than resumption of inflation. The unemployment rate at first glance, as always, seems to be okay, but if you're a little bit paranoid or more, like I am, then you don't really trust the data. And the more I start to look into it, as I showed you earlier, the more it starts to look more and more recessionary. Meanwhile, under the hood, there continues to be a bunch more deterioration. None of this stuff is going away. The only thing is, it's taken a lot longer than I thought it would. But to be honest, that's fine, because the longer we go, the easier it is to extract gains from the market. So by no means am I cheering on a recession or hoping and praying one shows up. I would actually much rather be totally wrong about that and this bull market continue to run for many, many months to go. That would certainly make my life as a cycle trader much easier. But undeniably, you look at this data and you say, is all of it worthless? Does none of it mean anything? I don't believe it does. I think the writing has been on the wall for a long time. And I think at some point, this is all going to become very, very obvious. For now, though, it seems okay. Longs continue to work, long positions continue to resolve to higher highs, and until such time as that changes, until such time as we see failed cycles and a true trend reversal, then I have to ignore my feelings and I have to just focus on staying on the right side of the trade, which for now is to the long side. If you're a level 3 member, look out for the members only video for you guys I'm going to put out. We're going to be setting up a bunch of crypto related equities as we head into the next couple of weeks. For everyone else, please do tune in on Monday. I hope you all have a fantastic weekend, and until next time, take care from me. All the best. Cheers. Bye.
Camel Finance, he's the man to see, rocking the markets with his contrarian spree. Trades like a pro, no fear, no shame, sticking to his guns in his money game. He's a badass, oh yes indeed. Camel Finance got the markets key, taking us